So the Federal Reserve has found itself in a difficult position. It's committed to tackling inflation, which it should be. It's been hiking its short-term benchmark rate, the federal funds rate, in an effort to contract the economy, to slow consumer demand, which should push down prices and ultimately ease inflation. Its pace of rate hikes, however, is also impacting banks and financial institutions by devaluing aspects of their portfolio, specifically bond portfolio. And we saw this play out last week with SVB Financial, where in an effort to meet its obligations, it sold off a rather large portion of its long-term bond portfolio, taking a $1.9 billion loss. When word spread, there was this run on the bank. $42 billion worth of withdrawal request by Thursday, which it wasn't able to meet, forcing regulators to step in and take over. Now, this prompted this, widespread concern, this panic of banks' liquidity and whether they'd be able to properly service their customer base, not just here in the U.S., but globally. It also prompted a flight to safety where investors take money out of risky investments like stocks and instead prefer a safe haven asset, a safe, stable investment like bonds. When money's flowing into bonds, it pushes down yields, which ultimately pushes down rates. This is one of the reasons why we've seen mortgage rates improve over the last couple of weeks. Now, another reason for the improvement has been incoming economic data. Tuesday, we had CPI, Consumer Price Index, which showed inflation is continuing to soften. We've seen Producer Price Index, retail sales, manufacturing data, all coming in below forecast, telling the Fed that their actions are working to slow the economy. Now, this makes next week's decision that much more difficult, right? The upcoming Fed meeting Tuesday and Wednesday. Will they hike rates? Will they hold rates, where they are currently? There's definitely been varying opinions. Will they do 50 bips, 25? Will they hold them at 0? The concern is if they don't hike rates, is inflation going to pop back up? On the flip side, if they do hike rates again, are they going to cause further risks to those banks who have not properly managed their bond portfolio? So that is certainly, the two issues that the Fed is wrestling with. Now, in my opinion, more important than the hike is going to be the release of the dot plot. And this is when the individual Fed members provide their projections for the federal funds rate through the end of 2023, 24, and 25. It kind of serves for the markets as this predictor of future economic conditions, which directly impacts mortgage rates. Remember, mortgage rates are not based on what's happening currently. They're based on longer term bonds. They're based on projections of economic conditions years down the road. So this is what ultimately a lot of the markets will be focused on. Now, it's going to be on Wednesday at 2 o'clock will be the announcement. And then at 2:30 is when Powell takes the podium for a prepared speech and a Q&A session. That's where you're going to see the majority of any kind of market volatility. What will he say and how will he deliver it? If you have any questions about these headlines, about these recent rate trends, or if you want to discuss how these recent rate improvements have impacted your purchase power, let's talk. This is Billy.Saylor, your mortgage professor, 571-330-5884. Have a great weekend.